Okay, sorry, so sorry about that. I'm not sure why I went on mute. Hello everyone, welcome to the session. In the previous module, we spoke about applications of financial analytics. Today we are going to take the discussion to the next level. And we are going to talk about the difference between risk-return premium, risk-return trade-off, indifference curves, utility function, quadratic utility, so on and so forth. The first thing is households. Let me also so households are nothing but people like you and me, and we earn income. Typically, there are two things we can do with our income. One is either you consume your entire income or you save and invest. Say you are earning $10,000 per month. Either you spend the entire money, that means you're consuming your entire money, or you might say that I'll, spend $6,000 and another $4,000 I'm going to save. Okay. Typically, this is how humans behave. I'm assuming that you're not taking this money and putting it underneath your mattress. If you just put it underneath your mattress and sleep on that, then you not be earning anything from that saved money. A person who is intelligent enough would actually ensure that this saved money is actually is invested in a wise asset, such that you get some money out of that, some return out of that. That's called as simple investment. You're taking the money that you earn, certain amount is saved, that saved money, you are investing it back in some business, some assets, some real estate, some gold, some mutual funds, wherever you want to invest. Why do you want to invest? Because we want to trade consumption intertemporally. Temporary. What does that mean? You don't want to consume the entire money now, whatever $10,000 you're earning per month. You don't want to completely utilize that. Instead, what you want to do is you want to consume it intertemporally, meaning every month some amount is what you want to consume. In the absence of any other investments, if I assume that you don't have any investment alternatives, you don't have any other option to invest, then we would simply store dollars, rupees under mattress. But then if you invest it in some location, we earn a return on our investment. Be it a fixed deposit, for example, you keep getting interest on that. And it keeps making money work for us. Whatever money we have, we are earning on top of that. So it's making money work for us. The bottom line here is that saving, that means investing typically, is simply a way of postponing today's consumption for tomorrow. I don't want to consume the entire money today. I'm investing it so that I might consume at a later point of time whenever I have a need, etc. That's the basic idea behind investment. Suppose You invested $100. And suppose there are two investment opportunities. Two. Investment plan A and say you have investment plan B. So you have two plans in place. If you invest in plan A, you would get $110 for some time period, maybe say per annum. Per annum. In 1 year, you get 10% rate of return. Okay, so that's plan A. Get $100. Investment plan B is, if you invest $100, you get $117 in return. That is investment plan B. In this, you get 17% rate of return. Which option would you prefer to invest in? If I were to simply ask you this question on, where do you want to invest? Would you invest in A or B? Right? A lot of you all are saying that, do you know what? It really does not warrant you to invest on A or B. Instead, we need to look at associated risks. If I'm investing $100, one plan is saying I'll get $117. And one plan is saying I'll get $110. So if you invest, say $100, I'm saying after 1 year, you get $110. This is plan A. If I have $100, if I'm investing, there's another plan called plan B, in which I get $170. It really depends on another factor called as risk. You cannot determine any of these options. You cannot simply determine an option A or B without knowing what is the risk in that. Okay, if I take more risk, I invest in A, that's all wrong statements. You cannot. B has a high risk than A. How do you know about that? What did I say about that? What if I say this is government bond? Option B is investing in government bond. And option A is investing in cryptocurrency. Until and unless you listen to the risks, you cannot comment anything. Okay. Now I'm talking about risk. Just because you get less money, it has less risk. Just because you get more money, it is more risk. It's not like that. It depends completely. That is the point that I'm trying to drive. Just by looking at this information that you have, you cannot comment, you cannot take decisions. Simple. There's no if and but and no scenarios here. Simple. If I don't know where I'm investing, if I don't know what is the risk, you cannot say which one is good. Now, if I say that option A is investing in a T-bill. T-bill is also called as government bond. If you're investing in a government bond or a T-bill, say you get 100% or sovereign bonds, whatever you want to call it. If you invest in these bonds, then governments usually do not default. Right? United States defaulted twice. Russian government defaulted once. Means they take the money from the people, from the citizens, and then they say, I invested somewhere, I don't have money now. Like Sri Lanka. What is happening to Sri Lanka? If you have invested in government bonds, still you might not get the money. Same is the case with One of the, you know, T-bills in Malaysia, I am forgetting the name of that. Okay, if I remember, I'll talk about it. So that's another example where government has defaulted. Indian government has never defaulted. That's the best part. We have a history of never defaulting. So this $110 is more or less certain you'll get it. 10% return on investments, 100% you'll get it because you're investing in a government bond. Say option B is you make $117 if you play casino. Or that's gambling, right? Or I would rather say if you invest in cryptocurrency, approximately $1 trillion are wiped out from the crypto market. $1 trillion. And that's a big thing. $1 trillion getting wiped out. So if I say that you invest in cryptocurrency, you will get $117 if you invest $100. So you get 17% return on investment. That means on one side you have something where you have huge risk, very, very risky. On another side, this is risk free. Now, if I ask you, is option A, are you going to choose option A or option B? What will your take be? Who all want to invest in A? Who are the various people who want to invest in B? So investing in A or B again here depends on your risk-taking appetite. It depends on your risk-taking appetite. If you are a kind of person who wants to take risk, you would choose option B. If you are a person who does not want to take risk, you will choose option A. So it depends on investors' risk appetite. So suppose that you have 100, okay, before that, I spoke about risk appetite, right? Let me talk about it. You'll have one zone or segment of people who are risk neutral. You'll have one section of people who are risk taking. And you'll have another section of people who are risk averse. If I were to give you financial analytics example, some example from finance. Say you are loan approving authority in your bank. Say you're working with State Bank of India and you are a loan approving authority. You either approve or reject the loan. If you build a machine learning algorithm, okay, wherein as soon as someone applies for a loan, they share with you details such as what is their age, what is their gender, what is their educational qualification, what is their income, are they married or not, all these details. You supply all these details to your machine learning algorithm, which will then predict on what is the probability that you're going to default. Okay, what is the probability that you're going to default? Then, if the probability says there is a 0.8% probability, or let me say that, let me not talk about that. If the probability is greater than or equal to 50%, 0.5, that a person will default on the loan, means they will take the money and run away. If there is more than 50% probability that someone will default on the loan, then the person who is risk neutral will reject the loan. That's okay, let me reject. There's more than 50% chance that this person will default on the loan. On the other side, you'll have risk-taking people. They might say that only if the probability of someone defaulting is greater than or equal to say 0.7, okay, only then I'm going to reject the loan. Here also, if the probability is greater than 50%, we are going to reject the loan. Then for risk averse people, you say that if the probability is greater than or equal to 30%, still this guy might say reject the loan. Risk taking person is saying even if there is 60% probability that someone will default on the loan, or even if there is 65% probability that someone will default on the loan, even if there is 68% or 69% probability that someone will default on the loan, don't worry, approve the loan. Even if there is 69% probability that someone will default, don't worry, approve the loan. I want to take risk, that's okay. Only if the risk or probability is more than 70%, then reject the loan. These kind of people are called as risk-taking people. Risk-averse person would be like, even if there is 30% probability that someone will default, reject the loan. I don't want to take any risk. I want to be very, very safe. Even if there is 30% chance, reject the loan. Those kind of people are going to be called as risk-averse people. Now, building a machine learning algorithm is very, very different than calculating the credit score. You'll have something called a CIBIL score. CIBIL score in India can reach up to 900 points. CIBIL score can be generated only if someone takes a loan. If someone has not taken the loan until now, you cannot say anything. At least you need to have a credit card, some banking relationship. If you are a person who has taken a credit card and if you have been paying all the statements on time, probably there'll be some credit score. Or if you take a loan and then repay all the installments, then there'll be some credit CIBIL score, which is sure. But if you're a very new customer who is applying for the loan for the very first time in your life, then you will not have any CIBIL score. But still, if you take all the inputs and supply to the machine learning algorithm, machine learning algorithms will give you a probability on whether a person will default or not. But the CIBIL score cannot be calculated if you are a person who is applying for the loan for the very first time. All right. This is about the risk appetite of the investors. Where do they invest depends on their risk appetite. Suppose the investor's choice or the investment choices which are faced by an investor with $100,000 happen to be these two. Suppose you are a person who has $100,000 with you. You want to invest somewhere. You have two options, choice 1 and choice 2. Choice 1 is a risk-free investment, which will grow to 105,000 in one period, meaning say 1 year. One period could be 1 month, 1 week, 1 year, 1 quarter, whatever. We are for our understanding, say 1 year. So in 1 year, you get $105,000. So how much did you get? It will be 5%. If you take 5% of this, you get 5,000. So you get 105,000. If you invest in choice 2, which is a risky investment, whenever we talk about risk can either be positive or risk can be negative. Usually people assume that negative means risk. Negative means a threat. It is a risk, but it's also called as a threat, negative risks. Positive risks are called as opportunities. So a specific risk can be positive or negative. Positive risks are called as opportunities. Negative risks are called as threats. Okay, next. If you invest 100,000, you might either get 150,000, which is an opportunity. If I invest, I might get 150,000. So that's an opportunity. 150,000 means 50%. And there is 6% probability or 60% probability, 0.6 or 60% probability, that you will get 50% return on investment. Threat. Your 100,000 might get decreased to 80,000. You might lose 20%. And for this 20% that you're going to lose, there's a probability of 0.4. There's 40% chance that you might lose 20% of your money. So whenever there's an investment, two things. One is either you will invest in a risk-free investment or you might invest in a risky investment. If it is a risky investment, either you might get some money or you might lose some money. Either you will get some money or you lose some money. Now let's do the comparison. If you want to know how that 5% we have arrived at, I told that you have say 100,000. If you are going to get 105,000, that means you get 5% return on investment. How is it calculated? New money 105 minus initial money divided by initial money or initial amount. When you solve it, you get in percentage terms. Of course, if you want something in percentage terms, you multiply it with 100. So I'll write the formula here. Final amount or final value minus initial value divided by initial value multiplied with 100. Final value minus initial value by initial value into 100. This will give you the percentage change. Sorry. Now, going by this formula, if you invest same 100,000, you get 150,000. How do you get 50%? 150,000 minus 100,000 divided by 100,000 into 100. This would actually give you 50%, and that is what we have here. Okay, why is it -1? This can be written as 150,000 divided by 100,000 minus 100,000 by 100,000. This can also be written in this way. If you're just wondering, if you're people who are new to math and calculations, this is what is happening. This would be 1. That's what it is. It's the same thing. Okay. Now, how did you get -20%? If you take this and if you take this, it is 80,000 minus 100,000 divided by initial value, which is 100,000, into 100%. If you multiply it with 100, you'll get a percentage. So here you get -20%. So the expected return on the risky investment is 0.6 probability into 50%. Means your risky investment might grow to 150,000 with 60% probability, or it might get decreased to 80,000. Decreased by to 80,000 means -20% with 0.4% probability. This would give you expected return. Expected return, friends. Just well, there are two things, my dear friends. There is something called a certain return, and there is something else called as expected return. Certain means 100% I'll get it. Like when you invest in government bond, government might tell you that on an average you get 8% return on investment. If you invest in PPF, public provident funds, etc., government might say on an average you'll get 8%. So when they say on an average you'll get 8%, it's a certain return because promised by government. And when you want to calculate average, on an average you get 8%, right? So if they make that statement, the average formula which is used is the simple math formula to calculate the mean. If you take 1, 2, 3, 4, 5, for example, if I say calculate the mean, you add all these numbers, right? If you add all these numbers, you get 15. You divide it by the count, which is going to give you 3. This is a formula. You add all the numbers divided by the count. Then, if you look at the formula pertaining to expected return, you take the same formula in xi divided by, you take the same formula, but now what we do is we multiply it with probability. For example, summation of I equal to 1 until n xi into, you multiply it with the probability of xi. Why? Because it's a risky investment. If it is a risky investment, you may get money or you may not get money. So there is some probability or some chance associated. You might earn some additional money or you might lose money. It is uncertain. Uncertain means there's probability associated. When probability is associated, the mean formula, this is also mean formula, mean or average, changes, and all you do is you just multiply this with the probability value and you give it a name called as expected return or mean. That is why expected return is calculated for your risky investment. But for your risk-free investment, you'll 100% get whatever the person is promising. And this usually we teach it when? In the first module or the second module of data science training. Yeah. First module, etc. We train people on expected value. Okay, anyways, so maybe you forgot. So it would be a good refresher for you. So if you solve that, you get 22%. So the expected return here is 22% for risky investment. Sometimes you might gain, sometimes you might lose. On an average, you get 22% return. If you stay invested for a long period, how long it depends on your thought process and your investment strategies, maybe 4 years, 5 years, etc. Then you get 22%. That's what it means. And risk-free investment is going to give you 5% return on investment. Let me write it here. Risk-free would give you 5% return on investment, and risky investment would give you 22% return on investment. Always when you start analyzing your data, you have something called as first moment business decision, second moment business decision, etc. Third moment, fourth moment, and so on. In first moment business decision, you ask questions such as, on an average, how much will be my return on investment? On an average would be the question that you ask. Okay. First set of questions would be that. Second set of questions would be, what is the variation in your data? Or what is the fluctuation in your data? Or what is the uncertainty in your data? And the second moment business decision measures happen to be variance, standard deviation, range, etc. So variance is a measure, or standard deviation is a measure which captures uncertainty in your data. If you have a value which is very big, that means there is a lot of volatility, a lot of uncertainty in your data. If you get a smaller variance or standard deviation value, that means there is less volatility or less uncertainty in your data. That is what it means. Like your expected value, expected variance formula also exists. Okay, normal variance formula is I equal to 1 until n, if this is population thing, xi minus mu whole square divided by m. This is your typical variance formula. When there is no probability involved, if probability is involved, it becomes expected variance. In expected variance, formula will remain the same, but the only thing is you are going to multiply this value with probability value. Xi minus mu whole square into probability of xi. This is your expected variance formula. And that is what is given. From the previous slide, we calculated that expected value or mean or mu is what? 22%. So you multiply, with probability. There is 60% probability. that you might get 150,000, right? That already in the previous slide itself we calculated. You have 100,000. There is 60% probability that you might get 150,000. There is also 40% probability that you might lose 20,000 and get only 8,000. So this was like 50% return on investment. This is like minus 20% you lose. Here you gain, here you lose. So xi happens to be 50%, which is nothing but 0.5, minus mu, which is expected value, mu is 22, which is 0.2, and square, summation surplus. Probability value is 40%, 0.4, into xi. Okay, xi is this time minus 20%, so minus 0.2, minus mu, expected value is 22%, 0.2, whole square. When you solve it, you get so much. This is a variance of your risky asset. Uncertainty or variance or fluctuation of your risky asset. So let me. And standard deviation is nothing but square root of variance. You already calculated that variance is 0.1744. When you take a square root of that, you get standard deviation and you're getting 34.29%. So sigma, which is standard deviation, is equal to 34.29%. So expected value or mean of this risky asset happens to be so much. For risk-free asset, return that you're going to expect is 5%. What will be the variance of what will be the standard deviation value for a risk-free asset? Risk-free asset doesn't have any risk. It will be 0. There is no risk. But for a risky asset, you have the values. Okay, let me erase it and write it down properly. Mu is 22%. Sigma is 34.29%. Here for risk-free, mu is 5%, risk is 0%. Sigma is 0%. Okay. This is the data that we have. Say you have two choices. Choice 2 is risky asset. So rather than investing in risk-free asset, if you invest in risky asset, how much more will you get? Here you will get 5%. Here you will get 22%. So how much percentage more will you get from 5% to 22? The difference is 17%. So if you move from a risky asset, risk-free asset to a risky asset, you get 17% more. Okay, so the expected return is 17% more. But then At what risk? If you take 34.29% risk, because from 0% to this 34.29% risk, then you end up getting 17%. So, is this return on investment commensurate with this? That means, is it worth? I mean, for 17%, are you willing to take 34.29% risk or not? It depends again on the individuals. It depends on investors' risk attitude, risk appetite. Okay. And that is usually called as A. And this falls under a specific domain called as utility theory. Utility means happiness. It usually depends on how happy or how sad an individual is. Very, very subjective, right? It completely depends on that individual. So it is very, very individual oriented. So there are a lot of models also available which facilitate the mathematical comparison of risk and return of various investment choices. And they are called as asset pricing models, like CAPM, capital asset pricing model. Now, there are two basic assumptions about any investor. Investors are greedy. There's nothing wrong in being greedy, right? I need more returns with less risk. I need more return on investment for the less risk that I take. So that is assumption one. Assumption two is investors are risk averse. Okay, meaning investors don't want to take risk. Usually that's a typical human mentality. Typical human mentality. I'm not saying everyone fall into that. Typically, majority of them, they do not want to take any risk. So investors are risk averse. And also investors are greedy. That means for less risk, they want more return. For less risk, they want more return on investment. And what is the essence of risk aversion? Okay, already we have spoken about this. Risk, there is a factor called as risk aversion factor, which is usually denoted using A. I explained about the risk attitude and all that, right? This is similar to that. If suppose you flip a coin, and if you get a head, you get $15. If you get a tail, you get $5. So the expected payoff is 10. How do you get 10? What is the probability of getting a head? 0.5. And for this probability, how much do you get? $15. And what is the probability of getting a tail? 0.5. And here, what is the money that you might get? $5. And how much are you investing? $10. Say you're investing $10. There's 0.5% chance that you'll get this. So 0.5 into this, same formula, friends. Expected value of I is equal to 1 until n xi into probability of xi. Here you have only two events, head and a tail. So you write it as I equal to 1 until 2 xi into probability of xi. When you substitute I equal to 1, you get x1 into probability of x1. Summation means plus. When you substitute I equal to 2, you get x2 into probability of x2. X1 here is 0.5, sorry, $15. So you put 15 into probability is 0.5 plus X2 is $5 into probability is again 0.5. So 0.5 of 15 is 7.5. 0.5 of 5 is 2.5. So you get 10. How much would you pay as an entry fee to be able to play this gamble? So you're saying that on an average you get $10. If you play a lot of games, on an average you get $10. And that's how we calculated this, right? So if I say on an average you get $10, yeah, I think I as well should have everything. So that's okay. Then, if you say that, do you know what? I'm willing to play this game by paying $10 as entrance amount. If you pay $10 as entrance amount, because you know that on an average you get $10, if you're paying $10, that is called as you being risk neutral. So you're being risk neutral. If you say that I'm going to pay only $8, then you are risk averse. Okay, you are risk averse if you pay $8. That means you are like, I don't want to take risk. I'll pay only $8 because I know on an average I get $10. Sometimes I lose, sometimes I win. I want to play very safe. I'll pay you only $8. If you're risk preferred person, if you're risk taking person, you would say that I'll invest $12 and let's play the game. I believe majority of the times it'll be head and I'll get money. Right? For $10, I'll be getting $15 each time. So I believe it's worth even investing $12. So you're risk taking risk, you're preferring to take risk. So these are the different risk attitudes which exist. Going back to this discussion, right? That if you have two options, one is risk-free, another is risky, okay? And then where do you want to actually end up? How much do you want to, where do you want to actually end up? Do you want to invest in a risky asset or a risk-free asset? For a risk-free asset, you get a return on investment of 5% and the risk is 0%. Whereas for a risky asset, you get around 22% return on investment for a risk which is 34.29%. Okay, so that is where we stand. Now, whether you invest in risky or risk-free really depends on appetite, risk-taking appetite of a person. Okay, so we need to understand the concept of something called as indifference curve. This is one of the amazing things which economists have come up with. A very good example. On one axis, they have put pizza. 0 pizza, 1 pizza, 2, 3, 4, 5, 6 pizza. On another axis, they have put beer. 0 beers, 2, 4, 6, 8, 10, 12 beer. And the curve is like this. This is called as indifference curve. Why? Let me help you understand. If you choose 5 pizzas and 0 beer, then you'll have some amount of happiness. You'll have some amount of happiness. The similar kind of happiness you'll have if you have 10 beers and 0 pizza. If you're given an option to have 5 pizzas or 10 beers, the amount of happiness is equal. Either you invest in buying 5 pizzas or invest in consuming 10 beers, it will give you equal satisfaction or equal happiness. So these two will have same utility or same happiness. Utility is equivalent to happiness. Or if you are a kind of person who wants to have 2 pizzas and maybe some approximately 3 beers, you'll be equally happy. Or if you want to have 8 beers and 0.5 pizza, half pizza, then also you'll be equally happy. The point is, wherever you choose, whichever point you choose on this black curve, you'll have equal happiness. There won't be any difference in your happiness. Since there is not going to be any difference in your happiness, it is called as indifference curve. Okay, there won't be any difference in your happiness, hence it is called as indifference curves. Indifference curve. Okay, on similar lines, you can draw expected return on y-axis and risk or standard deviation on x-axis. Hey, here the curve is like this. Here the curve is inverted y. On an average, people like both beer and pizza on an average. But on an average, people don't like risk. They like only the expected return. Hence the curve here is like this and here the curve is like that. Here both of these you like on an average. Here you don't like risk. You like only expected. And you have these utility curves, different happiness curves. If you are taking certain amount of risk, there are some properties of this expected of these indifference curves. We'll talk about that. If you are taking a certain risk, then you might get an expected return of so much, or an expected return of so much, or expected return of so much. If you have this amount of risk, either expected return is this or this. But where do you want to be? For the same amount of risk, are you expecting a return on investment of this A or B or C? Are you going to, for the same risk, expect, if given 3 options, would you go with A wherein you have less return, less expected return? Or would you want to go with C, which has more return for the same amount of risk? Where do you guys want to be? Greedy investors are greedy. Anyone, I'm also greedy. There's nothing wrong in that. Any common sense person would say that for the amount of risk that I'm taking, obviously, the more the return, better it is. So people will choose C. That's the first one. That means if you move along this northwest direction, the utility curves which fall above all would be the preferred curve for anyone. One more property is, as and how you keep taking more risk, this curve becomes steeper, meaning suppose you slightly increase the risk, the expected return curves, right? Even if they slightly increase, you're okay because you're taking a small risk. But if you take a huge risk, the expected returns, you're expecting more. It's not a linear thing. Linear means it be like this. You're expecting high return. on investment. Okay? So just remember this also, that as and how you keep increasing your risk, investors start expecting more and more expected return. Like on cryptocurrency, there's huge risk. If someone wants to invest, they want huge return on investment. Only then will they invest. Okay. These are the couple of properties of indifference curves. One is, for a given risk, you want to obviously choose a utility or happiness which lies at the very peak. I mean, if you move along northwesterly direction, you choose a curve which is there at the top. Then, if you are expected to take risk, if more risk is what you need to take, then the expected return will increase steeply, exponentially it will increase, right? If you pay me huge amount, huge return on investment, I'm going to take a risk. Okay, so if you move along northwesterly direction, utility increases. Point number one. Risk aversion means at lower levels of risk, it takes a small amount of return. Small additional return if you give, they'll be willing to take that risk. But as and how you proceed further and keep increasing the risk, the expectation from the stakeholders will increase, investors will increase. They will say, I want more return. Even more when you're a risk averse person, if you're a kind of person who doesn't want to take risk, then you will expect even more. You'll say, for that risk, I want huge return, only then I'll invest. Otherwise, I don't want to invest. So for a person, suppose you have two investors. This is related to investor A, related to investor B. If both of these people are getting 12% return on investment for 15% risk that they are taking, okay, 12% return is what they get for 15% risk. And suppose A is risk averse person and B is risk taking, less risk averse. Then if you say that I'm going to increase 20%, I'm going to add cryptocurrency into your portfolio, I will say that, also invest on cryptocurrency. So I'm increasing your risk. The moment your risk is increased, this risk averse guy will say, give me 19% return on investment. So from 12%, increase my return on investment, expected return to 19%. If that is a possibility, only then I'll take this 5% risk. Because this guy actually doesn't want to take risk. On the other side, you have B, who is less risk averse. This guy might say that for the 5% additional risk, you give me 14%, that is good enough. Give me 14%, I'm happy, I'll be happy. So from 12%, increase the expected return to 14%, and I'll take 5% additional risk. Because this guy is less risk averse, meaning risk-taking person. So when it comes to risk-taking person, the investors have flat indifference curve. For a risk-averse person, the indifference curve will be steep like this. That's the difference. So you have a steeper indifference curve and a flatter indifference curve. Okay, so I'll stop here, and tomorrow when we connect, we will take this discussion to the next level. Thank you all so much for watching, and please subscribe to our YouTube channels, because we are giving you, we are going to continue to give a lot of free things. Thank you all so much.